and also running a lot of the diligence type of work that we do to figure out what companies are the best fit for us and our investment thesis. Fortunate, OpenView super collaborative, so I work a ton on the sourcing side of things as well as on the portfolio side of things, but that's kind of my primary role. OpenView, for those who don't know, we are a B2B software investor investing at what we call the expansion stage. And to us, that basically means, we have a good sense for how companies behave over time. And so fundamentally, if we can answer questions like, where does a company find their customers? How expensive is it for that company to find their customers? And how do those companies' customers behave over time? Those are companies that we could get comfortable investing in. And that's, what we do. We try to take a really focused approach. So only invest in B2B software, only invest very particularly this expansion stage. And our funds are relatively concentrated. So, have on the order of 15 or so companies in the fund, which for the average venture fund is quite concentrated. And then the last thing that I find sometimes helps for people is just, what we've done in the past and what we're hoping to do in the future. So we have, 5 funds, $1 billion or so total in AUM. And then portfolio companies that you all might be familiar with. We led the Series B of Datadog. We're also investors in Calendly and Expensify. And then in Boston, also investors in Cogito. So that's the short version. And then in terms of me, I've also worked at a few other venture firms. So I worked most recently at a firm called Touchdown Ventures. They set up and run corporate venture funds. They're a great group, really innovative model. Also worked prior to that in Chicago at a firm called Hyde Park Angels, which is a seed and Series A investor focused in the Midwest. And then before that, I worked at the corporate headquarters of Target. And so I have an affinity for all things supply chain and retail and e-commerce as a result of that. And also spent a lot of my time in sales and marketing software, and really any application or vertical software is where my bread and butter. So I'll take a pause there.
We had Douglas Kim, the Chief Growth Officer at Cogito, on for a webinar a couple of weeks ago, doing contingency planning. Really knowledgeable guy. A lot of great sort of macro trend insights.
Yeah, he's great.
Awesome. All right, Matt, you wanna go ahead and give us a quick intro?
Yeah, for sure. And thanks for having us, Ross. This is totally awesome that you and the team really haven't skipped a beat on getting good content out there and welcoming in the whole community. So I'm Matt. I'm a principal at Bolt. We are an early stage venture fund focused exclusively on leading pre-seed and seed stage rounds. So typically writing the first check, anywhere a few $100K, all the way up to about $1.5 million or 2 million, depending on the stage. But to us, our philosophy really is that early stage in a company's life is a really unique time. It's really pre-revenue. You're really just sort of putting the real kind of foundational pieces together. And we really specialize on helping founders get that right. So super kind of disciplined and opinionated when it comes to things like finding product market fit, kind of figuring out when to scale, building the right team, and really just building a really robust foundation from which you can then build a high growth company. So we're based here in Boston as well as out in San Francisco. We're on our 3rd fund, and it's a $80 million fund. Kept intentionally on the smaller side to really keep us focused on working early with companies and really adding our value from that pre-seed and seed stage, and then getting our founders into a really great position to raise a killer Series A and go scale revenue from there. So my background, I've been doing early stage venture investing for the past 6 years. 1 year of that at Bolt. Prior to that, I was at another early stage venture co-creation firm in Boston called Allied Minds, focused mostly on what people now call deep tech. So doing a lot of semiconductor, space and satellite, telecom, robotics, et cetera. While I was there, I co-founded a firm or a company in the satellite communications business and ran that through its seed stage, through first product, first revenue, built the team, all that fun stuff, and then went and raised the Series A and hired a CEO to run it from there. So kind of dipped my toes in the water of the founder journey, but my heart's always been at the early stage. Engineer by training, but kind of quickly shifted into the startup world.
Awesome. And for everyone on the line, you may have noticed, and this was intentional on the part of Matt and Dan and myself, sort of by design. We sort of have Matt and Bolt representing an earlier stage than Dan and OpenView, because I think we all agreed that there's a good amount of content and opinions in the ecosystem right now that maybe sort of like the investor landscape is uniform and affected in the same way, and now expecting the same things from prospective investments or their current portfolio, when really there's some key differences from one stage to the next. So and we'll get into some of those things as we get into the conversation. But this conversation that we have today, and we'll go until about 12:45, we'll sort of take two parts. So in the first part, we'll learn from Dan and from Matt, their respective funds. How is the current climate affecting their organization specifically? What's changed? What hasn't changed? And then getting into the second part of the discussion, talking more specifically about, given the changes that have occurred, how does that affect sort of the investor pitch that OpenView, Bolt, and some others might expect to receive, and what are the changes sort of on the founder side and the pitching side. So we'll get going. Last reminder about Q&A. If anyone has questions at any point, there's a Q&A button at the bottom toolbar of your Zoom screen. Just enter any questions you have via that text portal, and we'll try to get them answered. So we'll launch into it. Matt, we will start with you. If you sort of just want to describe at Bolt, what's the current state of affairs given the current climate? Is the fund actively deploying capital at this time? Have investment criteria changed at all given the current climate? And do you think that there's been anything affected on the future side in terms of like ability to raise funding? And how do you see your LP sort of base affected right now?
Yeah, all great questions. I think what we're really been focused on probably over the past month and a half or so is really, and I think this will give people some good perspective on kind of where our head is at from the venture side, really spending the bulk of our time working with our existing portfolio and the founders we backed. Clearly it's a really tough time for everyone in the startup community. And all our founders are really navigating that situation the best they can. And what we try and do is just bring as much collective expertise around the table as possible to help guide their decisions, and feel very grateful that we've, both of our partners at Bolt have been through multiple downturns as partners at venture firms, and have seen, not this exact story, but some identical trends before. And so, the way we've been engaging with folks in the portfolio is really with a pretty heavy emphasis on cash runway. So most of our companies are kind of either, right at that seed stage, looking to their Series A, or maybe at their Series A, looking at their Series B. And I think the big kind of lesson takeaway from, the prior downturns that our partners have really pressed on is that the funding environment, it just takes a long time to recover. I think there's instances where some of your customer demand, while it softens in the near term, might be on a 9 or 12 month kind of horizon to rebound. And historically what's happened is actually the venture funding environment takes a little bit longer than that to kind of come back to a healthy level. So we're trying to prepare, with our founders we backed, that even if you have great kind of business traction in the next, 9 or 12 months, even if you get really good validation, getting that timing right of, being in a position of strength when the funding environment recovers is really critical. Because if you make a ton of traction, get really good value add or validation on your business in the next, 9 or 12 months, but there's no real, bona fide venture funding environment to go fundraise off of that traction, what good does it do? And it's really challenging to, have that progress really shine without a lot of dollars there to meet it. So we're really kind of pushing those folks to think about how to kind of improve runway at all possible, to really be able to be in a position of strength for not just 12 months, but hopefully up to 24 months. So how you do that, it's usually kind of making cuts harder than you may think, and really cutting early, using those savings to really extend runway. Trying to see if folks can kind of get to cash flow break even, which, as an early stage company is very tough to do, but it does happen. We've got companies who just have, 2 founders and an MVP who, have a shot of getting to cash flow break even in the next 6 or 9 months. And really kind of trying to focus on different ways to bring just more cash on the balance sheet. So whether that's talking to your existing investors, trying to find new investors, it's going to get harder and harder each week, I think, to raise additional capital. So even if it's not kind of exactly the terms you were expecting from a month ago, it's likely going to get worse. So we're trying to kind of focus on getting more cash on the balance sheet, and then getting creative with kind of your early customers, right? If there's ways you can convert your free pilots into paid pilots, or do some kind of clever upfront payments in different customer engagements, the better you can get visibility into that cash, the more it'll help your runway. So those are the few of the things that we've been really working on. I think one of the things that's really specific to the seed stage that we try and remind folks is that you really have an agility that is like probably at a local, if not absolute maximum for your company. And, as you continue to grow headcount and grow customers, you're going to sacrifice a little bit of that ability to move quickly. And also that ability to pump the brakes, right? And so, it's okay to go slow now if it means you have the potential to go fast later at the early stage. And, even if that means, going into hibernation for a little while your customers and the economy recover, it's there's not a lot of sense in burning yourself out on kind of cash and on just work hours if the customer demand isn't there yet. And I think a lot of, what we're trying to communicate is that it's okay to, there's nothing wrong with taking it slow for a little while for things to bounce back a little. And people at the early stage are kind of the unique time to do that. So, that's really where we're spending the bulk of our time. We are still continuing to look at new investments. We closed a new investment last week. We're still working on a few more. But I think the punchline is, the bar's higher. The environment's definitely changed. And, I can kind of talk a little bit more about how we like to see folks respond to that and what, that kind of implies for an early stage pitch. But maybe I'll stop here and we can keep the questions going.
Yep. And we do have one question in already. But let's switch over to Dan quickly and sort of get what's the current state of affairs over at OpenView. I'm sure spending plenty of time supporting portfolio companies right now, just like Matt and the Bolt team. But yep, Dan, current state of affairs over there. Are you guys deploying? Are criteria changing? And then Matt, I guess we'll also cover how you sort of see the LP base affected. But we'll kick it over to Dan first.
Yeah, for sure. I'll kind of start off with what we've seen that's changed and then transition to what really hasn't changed as much. So starting with what's different, certainly, Matt touched on it as well, but when I think about how I spend my time or how folks at the firm spend their time, certainly spending, we pride ourselves on being active investors and working with the companies as much as they would like us to work with them. But certainly the split of time we spend with the portfolio is greater now than it has been before. And the way that we're spending that time is really oriented around, scenario planning. And so what we've, encouraged our portfolio companies to think about, and I think is, a good way of thinking through things is, you need to plan for, a host of possible eventualities, and it's good to plan now so that you don't have to make those decisions in what can be really tense, high leverage moments. And so if you have a range of plans that go from, not doing anything different as a result of the economy not being different, obviously we know that that's probably, not the case. Things are different, but that would be the most, conservative, not in the sense of risk, but in the sense of, deviation from the norm. And then you go on and say, well, what if we only attain, 75% of our ARR target, or 50 or 25 or 0? And just because you plan for those things doesn't necessarily mean that you think that you're not going to hit any of your new revenue. But if for some reason factors outside of your control start to play out, and you have like predefined gates that say, like, if we see X, it probably means we're in Y scenario. And if we're in Y scenario, this is the plan that we've already decided on about what we want to do. Having all of that set up beforehand really helps the decisions be more rational and hopefully be, the right thing for the business. And being under the gun to make the decisions, we found is just really difficult for everybody involved. And so spending a lot of time on scenario planning and things like that. Also like Matt, we are still actively investing, so that actually hasn't changed. We wired a new investment, 2 weeks or so ago. And really our strategy around the types of companies we're investing in, the business models that we're excited about. For those of you who know OpenView probably know we're very invested and interested in companies that have what we can call a product-led growth business model, which is really all about businesses that can serve their customers directly without necessarily having a demo or a sales touch or something like that. And then the pace and size and frequency of our investment is still pretty consistent. But what is different is kind of our expectations around growth and ARR attainment, especially in companies where maybe you're selling to the hospitality industry, maybe you're selling to the travel industry, or maybe you just rely on really high touch enterprise sales cycles, which again, all businesses that we would be excited about and interested in, but we recognize may have particular headwinds right now. And so we're trying to be cognizant of those things and meter our expectations and kind of our benchmarks, if you will, appropriately. Obviously, it's still very early into what's happening. And so to say, growth of X as opposed to growth of Y before, we're not quite at that level of nuance. I think if you were, it would probably be over-optimizing and acting on insufficient data. But we are trying to be thoughtful in a qualitative way on all of those dimensions. And by the same token, also trying to be cognizant of companies that are countercyclical, who have maybe grown really quickly, but that growth isn't necessarily sustainable once the environment goes back to a more stable type of operations. And so all that to say that, we are still investing, still want to stay as close to our strategy as we can, but acknowledge that things are going to be different, and we're trying to incorporate those differences into our processes. And then the last thing that is different for us, which is, impacting us and we're still trying to think through, is we can't meet entrepreneurs in person. And given that we're normally leading rounds, given that we're writing checks upwards of 10, 20, maybe even $30 million, it's really hard to make those investment decisions when you can't meet people in person. It's the reality of the situation that we're dealing with, and we have to figure it out. This investment that we made, a few weeks ago, we've met with the team and knew them. But as we get further and further into the current situation, that's not going to be the case. And so that's, I think, the biggest thing that we're trying to figure out right now is how do we get comfortable with that reality and how do we adapt to it? Because it is reality and we do need to figure it out, and we want to keep investing, and we think there's opportunity now just as there was 2 months ago. But that is, a big change for us, and big change for everybody, certainly. So yeah.
Certainly heard that one as well. Matt, any, I assume similar challenge for the Bolt team, meeting prospective founders in person. Any learnings from your end? Any ways you guys are trying to tackle that one?
We're like Dan, we're figuring it out in real time. I think it's also a big challenge for us. The ones we'd worked with before or are working with kind of closing now, are folks that we've worked with in kind of previous startups, but it's very high on our radar to figure out how we navigate that, because a lot of our lifeblood is really backing folks who are doing something for the first time, and we may be meeting in person for the very first time.
Sure. So let's kick it over to a few questions that we have coming in, and I think this is going to take us into the second part of the conversation around how founders can incorporate the current climate into their investor pitch. Matt and Dan, for you both, we had We had basically everyone respond to the poll. The question was, how does fundraising apply to you right now? With the 3 answers being, I am actively fundraising right now, I will start fundraising in the next 3 to 6 months, or I am an investor just here to learn. And we had almost an even split between the 3. So plenty of folks on the line right now, either in fundraising mode right now or will be in the very near future. So we'll go over to questions right now. First question, you speak of timing, and I'd like to know if it's all right to hold back on sending a deck to an interested investor or not. And the background there is we haven't opened a round, and I don't want to send slide decks now, but investors are asking. So thoughts there, Dan and Matt?
Yeah, I'm happy to start. I think this is, an eternal question from founders as to whether to send a deck or not beforehand, and whether to send one, if you're fundraising versus if you're not fundraising. Certainly things may be a little different now. My preference and my philosophy is I appreciate having the deck beforehand. I think it helps me learn more about the company that I can get from the website or the founding team's LinkedIn. And it helps make the most of the conversations. If I know who they sell to, what the use cases are, whom they view as competitors, all those are things that can help us get more out of the conversation. And I find value in that. That's kind of more of my general response to that question. As it relates to the specific environment now and whether, a different MO makes sense, if anything, it's not something I've thought a ton about yet. I think it makes more sense to send decks in advance now than it did before, just given that you can't meet in person, you can't have the context. And so anything you can do to help people prepare, help people understand, and make the most of the time together makes sense. Now, all of that said, do I think it's a good use of a founder's time to create a deck from scratch for a random one-off investor meeting if you are not actively fundraising? My hypothesis would be almost certainly not. And there probably are, collateral that you already have. Maybe it's a sales deck that talks about your company and what you do and how you operate. That could be valuable and can help an investor or whomever you're meeting with get more out of the conversation without, forcing you or the team to create something that, may not be necessary for where you are. So that would be my initial take on it.
Yeah, I'd agree with a lot of that. I definitely think it makes better use of both the founder and the investor's time to have a more productive discussion. I think we're typically doing kind of intro meetings that are 20 to 30 minutes and see just, a tremendous amount of kind of deal volume that we need to kind of make sense of and find good fits through. So it's always helpful for us just to be as prepared as possible going into that discussion. And, I think it's also for us just a good window into how the founder thinks about articulating the opportunity and where sort of their priorities lie sort of comes through in the presentation a bit. So, I wouldn't say that it's necessary to always send one out if you don't feel prepared, but I think I'd encourage you to kind of pair your investor meetings with when you've articulated kind of your business and investment round in a deck so that you can kind of have those go hand in hand. Sort of related point, I know you had the poll that kind of asked people where they were on the fundraising horizon, and to hopefully this can be valuable to anyone in that second bucket who's on that kind of 3 to 6 month horizon. Because what we've been seeing and really advising is, if at all possible, pull that forward. It's going to be much more challenging, it seems, given kind of the economic climate, to raise 6 months from now than it will be today. And to really hopefully, give some good critical care to thinking through the best timing for that. And it might not always be ideal, but there's more kind of in your hands to control now than there likely will be a few months from now.
Yeah. The other thing, just logistically, thinking about the question again of whether send or deck or not if you're not fundraising. One thing that I've seen founders do who are particularly sensitive to sharing information or putting a lot of work into a deck is you have the pre-read deck, which is basically still has information about you and the company, but wouldn't have the ARR chart or the net dollar retention chart. And those are things that, you might convey in a call, or you might not want in a deck that can get sent around. And so this idea of like having a pre-read deck that would be lighter touch but still conveys helpful information to set the tone is another thing that I've seen founders do that sometimes they find helpful and might be helpful in this case.
Makes sense. Makes sense. So for the materials that you both have been receiving, whether it's a deck or a call with a founder, what are some of the details that founders are including about the current climate that you appreciate and sort of value the insights that they're giving? Are there certain details or parts of that conversation where you think it's not the most valuable use of time? And are there any more details, explanation, plans for the future that you'd love to see more founders coming your way, sort of prepared with and having done their homework on?
Yeah, I'm happy to chat about that. I think it's a really tough time to be pitching, because I think, you want to obviously be optimistic about the prospects of your company and the state of the customers and, what the next 12 to 24 months will hold. But at the same time, the reality is it's going to be challenging for most folks. There are a few companies who will be kind of preferentially benefited under this environment, right? But a lot won't. And there's a lot of industries that are really going to suffer from the customer demand side and otherwise. And so, I think we see a lot of folks who are kind of looking for that silver lining and what this means for their business. But I think what makes the most impact for us is really just being, conveying a strong level of pragmatism. And we're not, it might be the right time to kind of ramp up sales, but it might not be, and it's okay to raise money under the premise of really building and getting the product right during this time, at least kind of at the seed and pre-seed stage, as opposed to really pushing hard on sales and customer acquisition. And I think one of the things that is really impactful for us as we meet with founders is really understanding how well they've internalized kind of the new environment, and both what they've seen from how their industry may have fared in prior downturns, and how the different levers of the industry sort of changed in various downturn environments, but also kind of where really is the best positioning to create value during this time. And it might not be the same kind of value creation levers that it was a month ago.
Yeah, I think that's all super accurate. I think the point about pragmatism resonates with me in particular. I mean, I talked about this scenario planning type of exercise that we've encouraged our portfolios to work on. And I think like conveying that even in a deck, like, is not the worst thing to do. And just saying, this was our original plan. This is how we were tracking through mid-March. This is what we're seeing since, the current situation began to play out. Based on that information, this is how we've revised our plan, or why we have chosen not to revise our plan. And this is what we're hoping to achieve. And still being ambitious and realistic about those plans, but doing it in a way that shows that you're not just like moving forward, without heed to what's happening. So I think that's a little bit of a naive approach that probably will rub investors the wrong way, and probably send the wrong message about, being overly optimistic. And I also think it shows that, you're being thoughtful as a leader, as a CEO, and you are like planning, and you have a plan for what you were going to do before. You're monitoring how it's impacting you, and you're updating that plan in real time. And you've thought through the range of scenarios that could play out from here, and you have a plan for each of those too. And if I, see founders who have that type of framing, I tend to find that really helpful to understand like what's achievable, is that aligned with our vision for what, the types of companies we want to partner with? If not, how can we help still? And it also shows just a degree of maturity and sophistication that, I find pretty helpful and illuminating in the process.
Of course. All right, so we'll go to a few questions quickly. And just a reminder for everyone who's on the line, if you hover on the toolbar at the bottom of your Zoom screen, there is a Q&A button. So you can hit that button at any time, submit a question via text, and we'll try to get it answered by Matt and Dan. So we have a two-part question here. One, general advice for pilot and pre-product stage companies. I think we'll probably likely hear more from Matt for that one. And then second part of that question, are you seeing a reduction on valuations? So we'll switch over to Matt quickly. I know, Matt, you mentioned trying to get free pilots into paid pilots. I'm sure you have a few other things that you're seeing some portfolio companies do. And
I think
that's with.
Yeah, for sure. I think the other thing that we're seeing kind of in the pitches for folks who are specifically kind of pre-product is, increased level of scrutiny around hiring plans, right? And so every kind of hire that's planned for, the next 12 to 24 months, I think we're looking very critically at and trying to understand, I think this is where, the scrappiest of scrappy founders are really going to shine. And if there's, hires that are doing a role that the founder may be able to do themselves, that, this is a time where we're seeing a lot more kind of pressure to deliver on the individuals than on just, building the organization. So that's one I think is kind of particularly applicable to pre-product folks. And yeah, the other is I think we don't always encourage folks to be really, open book with their customers when it comes to payment terms or, thinking critically about validating the business model, or usually take a higher priority than necessarily chasing the most dollars. But I think now is a time where kind of chasing more dollars makes a little more sense than it did a few months ago. And even if it's not quite, the validation of your business model that you were hoping to get, it's likely more important to get cash in the door now and kind of work in a little bit of a different way and kind of work on showing some of that business model validation further down the road.
Dan, any feedback on how you see valuations changing now and in the near future?
Yeah, for sure. We have a corp dev team that kind of keeps track of the SaaS, multiples for public companies. And so certainly not a surprise to anybody there, but maybe a double click into like SaaS specifically. If you look at expected 2020 earnings and valuation multiples relative to those, I think they've dropped from about 8x. I think we had them at 7.7, and now they're below 7 to 6.8. So obviously, again, not a big shock to anybody, but seeing the impact in the public markets and in software specifically, when it comes to what we're seeing at the private markets, it definitely is a little bit more just stochastic, like the data we see, especially like given that our strategy is like focused investment, we're only making, 5 or so new investments a year. We have heard anecdotally of things getting either retraded or valuations coming down. I think folks are probably doing that opportunistically, knowing that like there are fewer people who are investing. But at the same time, like multiples are still, relatively high on a historic basis from what we've seen. But again, like it's more anecdotal than anything, I would say. If I look at, how things have played out in the past, I would anticipate them to play out now. Like the public markets are kind of a leading indicator of how valuations move over time. And so starting to see, like I said, those anecdotal cases of valuations coming down. My guess is that'll continue to be the case. I'd be surprised if it wasn't. Especially as, if the economy continues to struggle a little bit and we enter more of like a recessionary type of period. But I don't, that's kind of like what we've seen so far. I wouldn't say we've seen, we've done a holistic, like in the private markets, how valuations are being affected, but anecdotally, that's what we're seeing. And obviously the public markets, everybody knows, and I would anticipate that's where it would go over time.
Sure.
Yeah, from a valuation side, I think just probably in the past 2 weeks, we've started to see them take a little bit of a dip at the seed stage. I think up until then, we continue to see a lot of momentum from deals that were kind of in play in February and early March with kind of terms that were being discussed prior to real kind of implications being felt on the investor side. So we're sort of just starting to see that dip now, and would expect it to continue to go down as people kind of rethink what it means to do kind of a brand new deal in this environment.
Of course. Very quick tactical question. Which channel do you recommend to reach out to VCs in these special times? So I guess for you both, have you noticed any change in the way or the platforms on which founders are approaching you, or has it been pretty much business as usual? And would you recommend any changes in how they do their outreach given the current climate?
Yeah, I can't say I've noticed a particular difference. I think obviously there's no in-person events, which sometimes can be helpful, but email, we have folks on our team who are big on Twitter, but I can't say I've noticed a big difference from before, nor I would maybe need to think about it a little bit more, but nor would I think that any type of different outreach method would be warranted.
Yeah, I've seen the same. We still do a bunch from, our website, Twitter, LinkedIn, and then, the kind of person-to-person referrals are just as strong as they've ever been.
Yeah. The one thing I would say on our outreach to companies is we are trying to be very thoughtful about when and how we reach out to companies. So we have a very active outbound sourcing program where we reach out to companies that we think could be a fit for us. And we're trying to be a lot more thoughtful about now's probably not the time to reach out to the company that sells to the restaurant industry or travel. Or if we do reach out, it's not, heedless of the situation. And it's hey, this is how we think we can help, or this is why we're reaching out. I think investors probably on a relative basis are more insulated from this, but that would be the only thing as I think about it. It's does the company focus in a particular sector that's more challenged than normal, or does the investor have portfolio companies where they're spending a lot of time working with them, and just maybe acknowledging that, saying, hey, I know that you may be spending a lot of time here, reaching out for this reason, this is why. That would be the only thing, maybe the message more than the method.
Yeah, got it. I have a good question here that I think is probably on a lot of people's minds and something they're weighing for themselves. I'll read through it quickly. Trying to decide whether to raise a smaller and hopefully quicker angel plus friends and family pre-seed type of round versus going straight for sort of a lengthier, bigger round. Pre-seed money will allow us to gain momentum faster. Don't want to raise twice if I can possibly go for a bigger round now. Yeah, I'm sure you both have founders coming to you now with maybe kind of thinking on both sides of that fence, or even supporting current portfolio companies now who are kind of weighing taking bridge or extension financing now versus being maybe a bit more conservative with cash burn and going for a larger round that they had planned for initially, but maybe a few months what that date might have been before the crisis. So for you both, for your current portfolio companies and prospective investments coming your way, do you see this great desire for shorter term sort of bridge financing? And what are your thoughts on approach taking financing like that versus kind of buckling down the hatch and going for a larger round later?
Yeah. It's a good question. I can start off. I mean, it's definitely a personal one. So the first thing I would say, I don't think there's a universal right answer. I think the variables that I would consider if I were a founder would be how is my business performing in the current environment? So do I expect to see a lot of adverse headwinds, or would I anticipate that investor would view this as a difficult time for me to go raise? In that case, if you have people around the table who are supportive and you feel like you need the money to hit the runway that you want to hit, which obviously, I assume will be longer now than it would have been before, I would probably in that scenario go forward with the bridge type of financing. I think it would be faster, it would be easier. It helps you continue to run the business without distraction at a time that is obviously going to be pretty fraught with obstacles and potential pitfalls. I think, the opposite case would be potentially something like you're either disproportionately counter-cyclical to what's happening right now and you're seeing really strong results. Or maybe you're in a really competitive environment and you think this is an opportunity to gain market share and you have a strategic plan for going about doing that. I think that can actually be a really interesting opportunity now too. We have examples of folks in our portfolio where, for one structural reason or another, their competitors are more impacted than they are. And they can go forward and capture market share, and raising a round could be a good reason to do that. And so if you can tell the story, and if there's a reason where either, like I said, you're countercyclical, you can capture market share, or you feel like you've built good relationships with investors and you can go out and raise that round and give peace of mind to continue doing what you're doing in a responsible way, that's where a round might make more sense. And now might be the time to do it. But I definitely do not think it's a one-size-fits-all answer.
Yeah, I definitely agree with Dan. I mean, there's a lot to consider. I think in general, if you're holding out for a larger round later, hoping that more value will be created with the company and thus kind of reflected in a higher valuation and less dilution, that is a trajectory that right now is very difficult to project. So, if you're thinking that, you'll go heads down and kind of have a fundraise 6-9 months from now where you can suffer less dilution, or you can prevent less dilution, it's very likely that won't be the case. Any kind of business progress you make could very well be offset by just kind of trends in valuations, and that might be more of a downward pull than any kind of real business project progress can compensate for. So that wouldn't be a reason to delay. And I think in most scenarios it makes sense to raise now if you can, and just make it last.
For sure. We're coming up on 12:45. Matt, Dan, thank you both for donating a bit of time to help some founders plan out their fundraising future. Is there a good way to get in touch with you guys? We had a lot of questions on the Q&A portal. Unfortunately, didn't have time to get to all of them. So I don't know if there's a good way to get in touch with you both.
Yeah, I'm always happy to answer questions. I'm on Twitter. My Twitter handle is @WhatTheDanHeck. My email address is on our website, which is danh@ob.vc. So either one of those are great ways to get in touch with me, and happy to answer other questions.
Great.
Yeah, likewise. I'm Matt@bolt.io, or you can find me on LinkedIn. Can't always get to every question, but I try. So thanks, Ross, for having us. This was great. Really enjoyed getting the chat.
I'm just going to take over the screen for one quick moment. So for everyone who's on the line, I just want to give you a quick snapshot of what's coming up for the Venture Lane Crisis Program slate. April 16th, so on Thursday, we'll have mindfulness exercises for stress reduction. Jen Earls, holistic life and career coach. This isn't meditation, more of exercises for identifying personal sources of stress and working through those things. We have Zoom IDs. Feel free to take a screenshot. It is a busy slide. Also Thursday, 1 p.m., we will have the next installment of our Fighting Bull series, where Christian Mogul, founder of Venture Lane, and Brian Denberg, managing partner at Agile Sales Method, will be interviewing Anthony Venus, co-founder and CEO at YayPay, about how YayPay is fighting through the current crisis, finding some success, and making it through with some positive stories to tell, which is the main theme of the Fighting Bull series. And then next week, 4/21 on Tuesday, keep momentum when enterprise customers hit pause. Today's webinar was a collaboration between Venture Lane, Bolt, and OpenView. The enterprise customer webinar will also be a collaboration, this time with the Mass Challenge FinTech program. And we'll be hearing from Kyle Costello, VP of Emerging Technologies at Radius Bank, and Ian Kennedy, COO at Harvard Savings and Wealth Technologies. So one on the enterprise side, one on the startup side, about how in the current climate, you might have had a very, very hot enterprise prospect who had to hit the pause button, or a new customer that had a delay implementation and therefore the recognition of revenues. And we'll be talking with sort of both sides of the fence, how they think you can sort of keep momentum going, and hopefully not stay paused for too long when those scenarios arise. So that's everything coming up from the webinars. From the Venture Lane side, you can always go to our website, which you can see down below. and see our full program calendar, or subscribe to our newsletter through our website, or follow us on LinkedIn. Once again, Matt, Dan, thank you so much for making the time. Really great insights. And we had a ton of interest in this one. Maybe there's a part 2 coming up in the near future. But thanks for your time today, and we hope you both continue to enjoy your wonderful work from home experiences and finding some good time for personal interest and reflection.
Awesome. Thanks so much, Ross. Really appreciate it. Thanks to everybody for coming.
Thanks.
Yeah, looking forward to being back in Ventureland before too long.
We do too. Not the virtual background type, the actual. All right. Thank you both.
All right. Thanks, everyone.
All right. Thanks, Ross.
Bye.